Hello, all my dear students. I hope you all are doing good. So, good morning to all of you, good afternoon to all of you, good evening to all of you, whenever you are watching the lectures. Now, last lecture we have started with CA Final Direct Tax, your fast track batch for 2023, and we have done few things of PGV. So, let's take the discussion ahead of PGVP only, and to be precise, the discussion on depreciation which we have started in the last session. So today the first thing which we are going to do is the discussion of additional depreciation which is given on page number 2.4. So let me talk about additional depreciation now. Additional depreciation, as I have told you in the last session, there are four types of depreciation under the income tax law, and one amongst them is additional depreciation. Now additional depreciation under the income tax law is given under section 32 subsection 1 clause 2a at the rate of 20%. Now there are few questions which we need to answer over here. First, this additional depreciation is eligible to which assessee? Is it eligible to every assessee? The answer is no. It is only eligible to assessees who are engaged in manufacture or production of any article or thing. So you should be a manufacturer. Produce anything, that is all fine. You should be a manufacturer or a producer. Second, business. You should be engaged in power generation or power distribution or power transmission. You should be engaged in business relating to power distribution or generation or transmission. In short, you should be engaged in business related to power. So if you are doing any of the two business which I have told you, that is manufacturer or power generation or power distribution, then you are eligible for this benefit. What am I supposed to do? You are supposed to purchase and use a new plant and machinery. You are supposed to acquire, install and use a new plant and machinery. The plant and machinery has to be new and new. Then you will get what? Apart from normal depreciation, you will get additional 20% depreciation. Sir, every year I will get 20% extra? No. Every year you are not going to get 20% extra. You will get in the year in which you purchase and put to use. It's a one-time benefit. It's not a benefit which is available every year. So if I purchase a new machinery next year, then you will again get in the next year. For one machinery, one time. For one machinery, one time. So in this year, I am purchasing one machinery. I will get 20% additional depreciation on that. Then on this same machinery, in the next year, I cannot get 20% extra. In the next year, I will only get the normal depreciation. Suppose in the next year, I purchase another new machinery. Then I will get additional depreciation on that also, provided it is a new machinery. Okay. So, the nature of business is manufacturer or power generation, power distribution, power transmission. What is the assessee supposed to do? Assessee is supposed to acquire, install and use new plant and machinery. He will get 20% additional depreciation. Sir, usage is also important? Yes. Use is important. If you just acquire and install and do not use, you will not get additional depreciation. Sir, what if I put to use for less than 180 days in the current year? Then you will get half depreciation this year and half in the immediately next year. So suppose if I acquire and put to use a new plant and machinery for less than 180 days in the current year, then I will get 10% in the current year and 10% in the next year. That is 50% of the depreciation will be allowed in the current year, 50% will be allowed in the immediately next year. Don't worry about it. It's written over here. Okay. So it's a one-time benefit? Yes, it's a one-time benefit for that plant and machinery. Okay. Now, listen carefully. There are certain machineries which the government has excluded from here. When I say excluded from here, it means you will not get additional depreciation on those machineries. Now, which are those machineries on which you do not get additional depreciation? Let me tell you. First of all, second-hand machinery. You don't get additional depreciation. You will only get the normal depreciation. Second-hand machinery is not eligible for additional depreciation. Second-hand means second-hand. Whether from India or whether imported, it doesn't matter. You can write over here. Even imported second-hand would not be allowed. Would not be allowed, would not be allowed, would not be allowed. Even imported second-hand would not be allowed. Okay. So second hand is absolutely not allowed. Okay. Then comes a machinery which is kept in office premise or guest house or residential accommodation, not allowed. We want machinery to be installed in factory, not at your house. Then ships not allowed. Aircraft not allowed. Vehicle not allowed. Ships, aircraft, vehicle not allowed, not allowed, not allowed. Regarding vehicle, I'll be speaking few more things when I'll be doing some questions. So whenever I'll be doing question, I have to speak few things about vehicle now. And I'm not saying that right now. Just try to remember these exclusions. I'm just saying it once for you all, first of all. So imported second hand, local second hand. Second hand is not allowed at all. Office premises, machinery kept in office premises, not allowed. Machinery kept in residential accommodation, not allowed. Ships not allowed, aircraft not allowed, road transport vehicle not allowed, and any plant and machinery which is already allowed as 100% deduction. If you have bought some plant and machinery and you have claimed 100% tax benefit on that, you cannot claim additional depreciation on that. For example, yes, I'll give you an example. Suppose I have bought some machinery for my scientific research department. I am doing some scientific research and I have bought some machinery. So you might be knowing that you might have done in CA intro also, in CA final also, we'll do in subsequent lectures. That if you are doing scientific research, you get benefit of 100% deduction on asset. So I bought a machinery of 10 lakh rupees for scientific research. I took 100% deduction of 10 lakh. Now that machinery cannot be eligible for what? Additional depreciation. That is what is written over here. Just check. That machinery should not be eligible for what? Additional depreciation. That is not allowed. Absolutely not allowed. Okay. Now, one doubt was raised by certain industries that if we are engaged in printing, then are we eligible for additional depreciation? So the government said yes, assessees who are engaged in printing are eligible for additional depreciation. Assessees who are engaged in printing and as well as publishing, they are also eligible. So you should be either engaged in printing or you should be engaged in printing and publishing. You are eligible for additional depreciation. Yes, if you are engaged in only publishing, you are not printing anything. You are not printing anything. You are just publishing. You are a publication house. Then you are not eligible for additional depreciation. So assessee engaged in printing or printing and publishing are eligible for additional depreciation. That is written in CBDT circular over here of 2015. You can check. So this is what this section is all about. I'll just raise some questions which you have to raise in your mind while revising. Nature of business. I have told you which are the nature of business. Second, nature of asset. I have told you which assets are included, which are not included. Rate of depreciation, 20%. Is it necessary to use? Yes. 50% will it happen? Yes. If it is put to use for less than 180 days, then 50% in the current year and the 50% in the next year. You can just go through it once. Now we are moving ahead towards some dangerous discussion. Now what are this dangerous discussion? You have to be very careful at this moment now. So now we are discussing very important issues. And that is what? Pay attention please. As we all know that in income tax law, we get depreciation based on which method? WDV. WDV is the method based on which we get depreciation under the income tax law. So the question is, what is WDV? Is the term WDV defined under income tax law? The answer is yes. It is defined in section 43.6. Section 43.6 defines the WDV. What is WDV, sir? Let me tell you what is WDV. What is exactly WDV? So WDV is equal to, as per section 43.6, it is actual cost of the asset minus depreciation actually allowed. So this is what generally the WDV definition is there in accounts also. Whatever is the cost, you have to reduce depreciation from that. That's it. Now, what do I mean by depreciation actually allowed? The word important over here is actually allowed. Depreciation actually allowed means, it means that depreciation that saves your tax. You have to pay attention please, all of you. That depreciation we are talking about, that is saving your tax. What do I mean by this? Now, what happens in accounts and what happens in tax? Suppose this is your P&L account, okay, and there is some depreciation over here, say 100 rupees. Now, when you compute your PGBP income, what you do? Please tell me, all of you. What you do while computing PGBP income? You add this depreciation, right? And then what you do? You reduce the depreciation as per what? Income Tax Act. So, suppose that is 150 rupees. So, this 150 rupees which you are reducing, is it allowed to you or not? Is it actually allowed to you or not? The answer is yes. Is it saving your tax or not? The answer is yes. This 150 rupees is saving my tax. So the government is saying as simple as this. That depreciation which is saving your tax, that can be called as actually allowed. And something which is actually allowed has to be reduced from the WDV. You have to just understand this link. A depreciation which is your saving your tax is actually allowed, and something which is actually allowed has to be reduced from what? From the actual cost. This link has to be maintained. So now this is what it is written in the provision also. If you go to the previous page, there is a provision over here. How to arrive at WDV for the next year? If you come to page number 2.3. As per section 43.6, WDV, the definition of WDV is given here in section 43.6. WDV means actual cost as reduced by depreciation actually allowed. Just write down over here by putting a circle beside actually allowed. Actually allowed means that depreciation which saves tax. Okay. Now, you have to be very careful now with respect to this discussion. I am just going slightly in the corner so that I can show you the entire board properly. Now pay absolute attention with respect to the next provision. It's a beautiful one. Great logic is required to understand this. Shall I start? Listen. What I said, by default, you can only reduce that depreciation from the WDV of the asset which is actually allowed to you. Okay. A depreciation which is not actually allowed to you cannot be reduced. But there are two exceptions under the income tax law. In those two exceptions, even though the depreciation is not actually allowed to you, still you have to reduce from the block. Listen carefully what I am saying. There are two exceptions under the income tax law where the depreciation is not actually allowed to you, but still you have to reduce from the block. Which are those two exceptions? First one I am explaining with the help of example, and then I am saying the exception to you. This is the example which is there in front of you. Listen to the example very carefully. Then you will understand. This is your P&L account. Okay. You have purchased one furniture of 100 rupees. Furniture is depreciable at the rate of 10%. Okay. This is your sales of 100 rupees. This is your expense of 120 rupees. It means your expense is far greater than your sales. And this is your depreciation of 10 rupees. That is 100 into 10%. So now if you see properly, your sale is 100, but your depreciation and your expense is 130. Therefore, there is a loss of 30 rupees. Right? Now, in income tax law, you do not treat this as a loss. You divide that into two parts. Do you remember that in CA intern? The loss which is coming because of depreciation, that is 10 rupees. It will be called as UAD, unabsorbed depreciation. And the loss that is coming because of expense, that is 20 rupees. That will be called as business loss. So you have to segregate the entire loss of 30 rupees into two parts. In accounts, you say loss as loss only. In accounts, we do not use the word business loss or unabsorbed debt. But in tax, it is not like that. In tax, you have to segregate that because the treatment is different for unabsorbed depreciation and business loss. So you have to segregate the unabsorbed depreciation and the business loss. Okay. Yes, I have segregated, sir. Now what to do? Now compute WDV. Compute WDV. So what is WDV? Don't see anywhere. See at me. What is WDV? WDV is actual cost minus depreciation actually allowed. Now you think logically. Is there any depreciation allowed to you in the current year? Is there any depreciation allowed to you in the current year? And the answer is no. Why? Why there is no depreciation allowed in the current year? There is no depreciation allowed in the current year because You already have a lot of expense of 120 rupees. Just go through this example once. So just focus on one thing over here. Are you getting any deduction of depreciation in the current year? No, we are not claiming any deduction in the current year of depreciation actually. Why? Because you see, common sense says what? You already have a sales of 100 and you have expenses of 120. Now 120 rupees expense is sufficient to make you put you in loss, yeah? The depreciation is not getting used in the current year. The depreciation is intact. It is in fact getting carried forward to the next year, and next year it will be allowed as deduction. That is the reason it is termed as what? Unabsorbed depreciation. Now listen carefully, please, all of you. This depreciation is not allowed to you in the current year. If it is not allowed to you in the current year, what is the definition of WDV? The definition of WDV is actual cost minus depreciation actually allowed. Is there any depreciation actually allowed to you in the current year? No. And therefore, the WDV of the next year will be 100 rupees. Now, if I apply this formula, there is a problem in this formula. Why? You think mathematically now. You have to apply your mathematical mind. You are showing your 100 rupees as sales. Listen carefully. You are showing 120 rupees as expense. Okay. You are showing 10 rupees as depreciation. And you are showing 10 rupees depreciation is unabsorbed, which I will carry forward and set off in future years. Okay. That is all fine. You can carry forward and set off this depreciation in future year. So you will carry forward this set off and depreciation in future year, and at the same time you think like this. You say that this depreciation is not allowed in the current year, therefore I cannot reduce from here. And at the same time you will keep your WDV intact in the next year at 100 rupees. So what will happen in the next year? In the next year what will happen? You will have double benefit. How double benefit? Because from previous year you are carrying forward 10 rupees, and in the next year you are again depreciating at 100 rupees. Will this amount to dual benefit or not? It will amount to dual benefit. And because of this, the government has brought a provision. What is the provision? That depreciation deemed to be actually allowed means what? That as per explanation 3 to 43.6, any UAD carried forward under section 32 subsection 2. If you are carrying forward any UAD under section 32 subsection 2, shall be deemed to be actually allowed in the current year. You have to be deemed to be allowed in the current year. So it means whatever is UAD which is coming in front of you over here, that is deemed to be actually allowed. It is not actually allowed, but deemed to be actually allowed. You have to reduce from the block and make it 90 rupees. See, the moral of the story is very simple. I am trying to explain you the logic. If you understand the logic, well and good. If you don't understand the logic is not written anywhere. It's not written in your study material. Your ultimate treatment will be what? It's very easy anyways to understand the logic. There's nothing great. There is no rocket science in this. It's a basic mathematical logic. But ultimate treatment is what? Unabsorbed depreciation. If there is unabsorbed depreciation in the current year, is it allowed to you in the current year? No, no, no. If it would have been allowed, I would have not called that as unabsorbed. Na? It is definitely carried forward and it will be allowed in future year. But you have to reduce from the block in the current year. It is deemed to be actually allowed. Even though it is not allowed to you in the current year, but it is deemed to be actually allowed in the current year. So you have to reduce from the block of asset. Is it clear to all of you? I hope it is clear to all of you. So this is what this provision is all about. This is the first exception. So by default, what the law says? Pay attention, please. By default, the law says that you have to reduce what? You have to reduce the depreciation actually allowed from the block of asset. But unabsorbed depreciation is not actually allowed. Still you are reducing from the block of asset. Are you reducing or not? Yes, we are. Unabsorbed depreciation is not actually allowed to you. Still you are reducing from the block of asset. You are reducing from the block of asset, and that is what the provision is all about. This is the first exception, okay? Now, second exception. To explain the second exception, which starts from here and ends here, it's a 3-line exception. I have to explain you with the help of an example now. Pay attention, please. Suppose there is an assessee engaged in growing and manufacturing tea in India. So there is an assessee who is engaged in growing and manufacturing tea in India. Okay. It's doing both the composite activity. And the PGBP from the same is say 300 lakhs, yeah, 3000 lakhs less depreciation at the rate of 15% on rupees 1000 lakhs. Okay, this is the cost of the asset. This is the actual cost of the asset. So this will come to 150 lakhs. And therefore, this will be how much? This will be 2850. Okay, now what happens after this? What happens after this? You have to be understanding that very precisely. You would have done in CA Inter also in agriculture income. If you are growing and manufacturing tea, both, then this entire amount cannot be called as taxable. Only 40% is business income. You remember that? And 60% is agriculture. And if 40% is business income, then 2850. 40% of that comes to how much? 1140 is business income. And 1140 minus 2850, 1710 is what? Exempt. Is exempt income. Okay. You would have done that in CA Inter. In CA Final also we'll be doing in the next topics. For tea, coffee, rubber, somewhere it is 40-60, somewhere it is 25-75, somewhere it is 35-65, so on and so forth. Okay. But here for tea, it is 40-60. 40% business, 60% agriculture. So everything is fine till here. Now we have to compute WDV. So what is WDV? WDV is actual cost of the asset minus depreciation actually allowed. Actually allowed means what? That depreciation which is saving your tax in the current year. Which is saving your tax in the current year. Okay. So what the assessee is saying? What is the stand of assessee? Assessee is saying that actual cost is 1000 lakhs. Okay. Minus depreciation actually allowed is not 150 lakhs because out of this 150 lakhs, I am using only 40% to earn my taxable income and 60% is used for earning exempt income. Listen carefully. Assessee is saying that whatever assets I am using, out of that 40% is used for taxable income and 60% is used for exempt income. So my actually allowed depreciation is only 40% of this amount. The assessee is making that argument that my actually allowed depreciation is only 40% of this. So 40% of this will come to 60 lakhs. And the assessee is saying that my WDV for the next year is on a higher side, that is 940 lakhs. This is the argument made by the assessee. This is the argument made by the assessee. Why assessee is not reducing 150 from here? Because assessee is saying that my entire asset is used partially for business, partially for exempt income. Therefore, the asset which is used for exempt income, that depreciation is not allowed to me because that is used to earn exempt income. When an income is exempt, the question of deduction does not arise only. So, deduction is only with respect to 40%. So, I am getting deduction only with respect to 40%. So, I want to deduct from here only 40% of my depreciation. Okay. I will only reduce 40% of my depreciation from here. Okay. And after that, my answer will come to 940 lakhs. Okay. Now listen carefully. So the government came into picture and the government said that, Acha, we have made a provision now. In case the income is partially from agriculture. Yes, it is partially from agriculture. And partially from business. Yes, it is partially from business. Then it is deemed that it is only from business. You deem that it is only business only. And the entire depreciation is deemed to be allowed for the business. Entire depreciation is business only. Entire 150 lakhs, you assume that it is for business. In short, reduce entire depreciation from the block. In short, you have to reduce entire 150 lakhs from the block. So now, after the amendment, this amendment came long back in 2009. This stand of assessee will not work. Assessee, what he is supposed to do? 1000 lakh minus what? Assume that entire depreciation is coming from business. and reduce the entire depreciation and show the WDV of the next year on a lower side. You cannot show on a higher side of 940 lakhs. Okay. So these are the two exceptions. First exception. By default, WDV is actual cost minus depreciation actually allowed. By default. Whatever is the actual cost, you reduce depreciation actually allowed from. Actually allowed means that depreciation which is saving your tax in the current year. But there are two exceptions where it is not actually allowed to you. Still, you will reduce from the block of asset. First, unabsorbed depreciation is not allowed to you in the current year, but still it is deemed to be allowed. And here, this 60% agriculture income depreciation is not actually allowed to you, but you assume that entirely it is from business and reduce entirely from the block of asset. This is what this provision wants to tell you. Take a photograph of this. This example will help you to build the concept in a better manner. Okay. So when this provision comes with respect to tea, coffee or rubber, what you will do? While computing depreciation, you will not do anything. You will compute depreciation normally and you will reduce the entire depreciation from the block of asset. You will not segregate into 40-60 for depreciation purpose at least. Is it clear? I hope it is clear to all of you. Now, one last thing I would like to say over here. I hope you have taken the photograph of this. And that is with respect to goodwill. With respect to goodwill, the government has made a very big amendment from 2020-21 onwards. So, from financial year 2020-21, deduction of depreciation on goodwill not allowed. It means what? It means if I purchase a new goodwill in financial year 2021 and further, then no depreciation. Okay. Depreciation will not be allowed to me. Okay. Now the question is, what if I have purchased earlier? Suppose if I have purchased some goodwill in financial year 15-16. Some goodwill was purchased for 10 lakh rupees. At that time the depreciation was allowed. And that depreciation would definitely be forming part of my what? It will be definitely forming part of my WDV as on 1/4/2020. That is the first day of this year. Yes or no? If I have purchased goodwill in earlier years, in 15-16 it was allowed. In 16-17 it was allowed. 17-18 it was allowed. 18-19 it was allowed. 19-20 also it was allowed. So the government says what? In that case, you have to take this goodwill and you have to reduce the depreciation of all these years and see what is the WDV on this year. Whatever is the WDV on this year, you have to reduce on the block of the intangible assets. We will not allow you depreciation on the old goodwill also. So, definitely if you purchase a new goodwill now, you will not get any deduction. But if there is an old goodwill in the intangible asset block, is it possible or not? In the intangible asset block, there is an old goodwill. So, you have to remove that goodwill, that much WDV of that goodwill in financial year 2021 from the WDV of the intangible asset. You have to remove that much from the intangible assets WDV. I hope it is clear to you. So this is what it is written over here. If the value of the block of asset and 1/4/2020 includes goodwill of a business or profession on which depreciation was taken by assessee in any preceding year, then the depreciated value of goodwill shall be deducted from the value of the block of asset on 1st April 2020. So whatever is the depreciated value, you have to reduce from the block on 1/4/2020, so that from 2020-21 onwards, you don't get depreciation on old goodwill also. You will not get on old goodwill also. Okay. So now let's go ahead with the next part. The next part is what? Pay attention, please. The next part is an extension of what we have started today. What we have started today was WDV ka discussion. So the next part is WDV is equal to actual cost minus depreciation actually allowed. So the next part is, what is actual cost then? What is the definition of actual cost then? If WDV is actual cost minus depreciation actually allowed, then what is the actual cost? And honestly speaking, in the first year, the concept of WDV does not arise only. The concept of WDV will come from second year onwards now, because in first year, actual cost is itself relevant to claim depreciation. In the first year, you're not interested in the WDV. The WDV will come into play from the second year onwards. Therefore, the bigger question is what is actual cost? So let's start the discussion of what do you mean by the term actual cost now. What is actual cost? Is the word actual cost defined? Yes, it is defined in section 43.1. So how is it defined? It is defined as follows. Actual cost means actual cost. The term actual cost means what? Actual cost of asset to the assessee as reduced by that portion which is met directly or indirectly by any person or authority. Now, what do I mean by this? It's a very strange, it's a very vague definition. When I ask you what is actual cost, you say actual cost means actual cost. Such a vague definition it is, such a strange definition. But the government has thought something before saying it. They are not just putting the definition for the sake of putting it. There is some reason behind it. What is the reason? Why they have put such definition of actual cost? They could have easily said actual cost means price of the asset. No, no, no. They are not saying price. They are saying cost. The word cost is very wide as compared to the word price. If somebody asks me, what is the price of the TV which is hanging in your office? I will say it is 50,000 rupees. But if somebody asks me, what is the cost of this TV? I would say, wait. 50,000 rupees I paid for the TV. Then 5,000 rupees I paid for that stand. Then 2,000 rupees I paid for that electrician. Then 2,000 rupees I paid for that for the purpose of what? For the purpose of delivery charge of the TV. The total, the actual cost of putting the TV into working condition is 50,000 plus some expenses more. Say 50,000 plus 5,000 plus 4,000 plus 2, whatever expenses. That is my actual cost. So the word cost is very wider as compared to the word price. The word cost means all those costs which are necessary to put the asset into working condition. Whatever expenses you are incurring to put the asset into working condition will be part of what? Actual cost. Will be part of actual cost. Forget about this. Not only this. If you are taking a loan, what? If you are taking a loan, okay, on which you are paying interest. So till the time the asset is not put to use, till that time you have to capitalize the interest also to the cost of asset. You would have done this in your what? In your accounts also, financial reporting. Say for example, I have taken a loan in pre-commencement period. Whatever interest you are paying, you have to add to what? Cost of asset. Even Supreme Court of India says that in the case of Challapalli Sugar Mills Limited. Supreme Court has held that in this case, that whatever expenditure you incur in the form of interest, till the time the business is not started, you have to capitalize to the cost of asset. Okay. What after the business is started? After the business is started, then also, suppose if you have taken a loan of 10% loan of 10 lakhs and you have purchased a fixed asset. You have taken a loan on 1st April 2022 and then you have purchased the fixed asset and you have put to use on 1st October 2022. So this much period, from year till year, whatever interest you have paid, you have to capitalize to the asset. And you have to claim what? Depreciation on that much interest. Once you have put the asset into use, then you can claim the interest as what? As an expense. As which expense? As the revenue expense. But till the time the asset is not put to use, you have to capitalize the interest to the cost of asset. Okay, you can see this, all these things are given over here. If his interest is incurred after commencement of production, then it shall be allowed as a revenue expenses. In short, till the time the asset is not put to use, capitalize the interest expense. Once the asset is put to use, then claim as revenue expense. Therefore, the word actual cost means actual cost is a very wider term. Actual cost means actual cost. It means it shall include all those expenses which are necessary to put the asset into a working condition. Whatever expenses you incur to put the asset into working condition, that shall form part of actual cost. I hope it is clear to all of you, right? Now, at the same time, there is one more restriction. If you are purchasing an asset and if you are paying more than 10,000 rupees to any person, then you have, if you are purchasing an asset, suppose I am buying this mobile phone, this is an asset for me, and I am paying more than 10,000 rupees to a person in a day, then I have to make the payment by four modes, either by account pay check, account pay draft, ECS, electronic clearing system, or such other electronic mode as may be prescribed by the government. I'll be speaking about these four modes later on. Don't worry. In detail. I'll be speaking about that. But right now also I'm saying, if you are purchasing any asset and making a payment to a person in a day of more than 10,000 rupees, to a person in a day of more than 10,000 rupees, you have to make the payment by account pay check, account pay draft, ECH or such other electronic mode as may be prescribed. You have to make the payment by these four modes. What are these four modes? We'll be talking about this sometime later. Don't worry. Okay. It is written over here, but we'll have great discussion on this after some time when we are doing the disallowances under the head PGBP. Now, there is one small ICDS that also says the same thing. What I have said you, whatever expenses are related to fixed asset, you have to capitalize that. If they are not related to fixed asset, do not capitalize. Like example, admin and general overhead expenses are excluded from the cost if they do not relate to what? Specific tangible asset. If the expenses are not related to asset, do not include. If they are specifically attributable, then it shall be included as a part of cost of asset and then you have to capitalize. Moral of the story is very simple. All expenses which are necessary to put the asset into working condition and which are related to asset, you have to capitalize. Expenditure incurred on startup, commissioning of the project, including expenditure on test run, shall be capitalized. Expenditure incurred after the plant has begun production and production for sale or captive consumption shall be treated as revenue expenditure. So whatever expenditure you incurred on test run, etc., to check whether the machinery is working properly or not, whether the production is done properly or not, these are all pre-commencement activities. So whatever expenditure you done on test run, etc., all of them have to be capitalized. Once the production is started, after that, if you are incurring an expenditure, then it will be a revenue expense. Then it should not be added to the cost of asset. Okay. Similarly, one more ICDS is there with respect to what? Borrowing cost, which I have just spoken to you. That if you take a loan for the purpose of an asset, so you might have heard one technical word in accounts. Till the time the asset is a qualifying asset, you can capitalize it. You would have done this word in your accounts, in financial reporting, in borrowing cost. So if you take a loan, if you borrow some money for a qualifying asset, so till the time the asset is a qualifying asset, you can capitalize that to what? To the cost of asset. Sir, what is a qualifying asset? Qualifying asset means what? Qualifying asset means the same definition of accounts. An asset which takes substantial period of time for it to be ready for its intended use. Any asset which takes substantial period of time for it to be ready for its intended use can be called as a qualifying asset. Now, suppose if I take a loan, listen carefully. If I take a loan, which is directly for qualifying asset, then there is no issue. Then whatever interest expense will come, capitalize. Okay. But that is not always the case. Sometimes the loan is not directly taken for a qualifying asset, but it is what? A general loan, which is used for qualifying assets also and it is used for other purpose also. Then what to do? Then there is a formula which is given by the government, that much you have to what? Capitalize. See, there can be two types of loan. One which you have taken specifically for what? Capitalized asset, for qualifying asset. So loan which is specifically taken for qualifying asset, close your eyes and capitalize that much interest. But loan which is generally taken, some portion might go for capitalized for qualified assets, some portion might go for fixed assets, other fixed assets, some portion might go for stock, some portion is there in bank account, some is there in cash, some is there in investments. Then how to do that? Let's see. There is a formula which is given by the government in this ICDS. If the funds are borrowed, left hand side, specifically for qualifying asset. There is no issue only over here. When you know that this fund is for qualifying asset only, then close your eyes and you must capitalize. But the funds are generally borrowed for qualifying asset, not specifically. Then you have to capitalize in accordance with this formula. A into B divided by C. Now you will ask, what is A, what is B, what is C? What is A, sir? A is the interest amount. Which interest? The loan which is directly attributable to qualifying asset? No, no, no. General loan. Interest on general loan. A is borrowing costs incurred during the previous year, except borrowing directly relatable to specific purpose. It means which borrowing? General borrowing. This talks about which borrowing? This talks about general borrowing. So whatever is the general borrowing, you have to do what? You have to take it in point number A. Whatever is the specific borrowing, that is already capitalized over here. Okay. Now we are interested in A into B divided by C. Now what is B? What is B? B has 3 points. Wherever you fall, you have to take accordingly. Okay. Average of qualifying asset in the balance sheet as on the first day and the last day of the previous year. So whatever is the first day, 1st April 2022, take the value of qualifying asset. 31st March 2023, take the value of qualifying asset. Take the average. That is the point number B. What is point number C then? Point number C is nothing but the average of balance sheet total. Check. So it's a very simple and common sense provision. How it is a common sense provision? Let me show you. This is the balance sheet. This is last year, this is current year. This is last year, this is current year. Okay. This is 10% loan. This is qualifying asset. You have to take this plus this divide by 2. This will be your numerator. And then total this plus this divide by 2. This will be your denominator. And your interest of the current year will become point number A. Okay. But in point number B, there are multiple options which are possible. In point number B. In case the qualifying asset does not appear in the balance sheet on the first day, it may be possible. On first day, qualifying asset was not there. It started from June. On 1st April, it was not there. In case the qualifying asset does not appear in balance sheet in the first day, or both. Both means not on the first day also, not on the last day also. So it may be possible that qualifying asset was not there on first day. It may be possible it was not there on first day also and last day also. It started in June and completed in December. Then what to do? Then take half of the qualifying asset. Then whatever is the cost of the qualifying asset, take half of that as point number B. That's it. So if the qualifying asset is not there on the first day, or if it is not there on the first day as well as last day, started in June, completed in December, then whatever is the cost of the qualifying asset, divide by 2, take half. Okay. Point number 3, the third possibility. In case the qualifying asset does not appear in the balance sheet on the last day, it means it appears on the first day. It means it was there in the first day, but it was not there in the last day because in the meanwhile, during the year itself, the qualifying asset is no more qualifying now. It is ready for its use now. So on the first day it was there, but on the last day it was not there. Then what to do? Then take the average of the cost on the first day and the date of put to use. On the first day it is there now, take that value, and the date of put to use, whatever the value was, take that value, take the average of that. Okay. So there are 3 possibilities. In first possibility, opening balance also there, closing also there. In second possibility, opening is not there, or opening, closing both are not there. In third possibility, opening is there, closing is not there. Okay. This is B. In B, there are 3 possibilities. Once that is done, you have to divide by C. C is common for everyone. Divide by C is what? Total of average total of assets. Opening balance of asset, closing balance of total assets, divide by 2. And last but not least, once the asset is put to use, it shall be considered as a revenue expenditure and it shall be allowed as deduction under section 36, subsection 1, clause 3. Capitalization is only possible till the time the asset is not used. Capitalization is only possible till the time the asset is what? Is a qualifying asset. Okay. Just go through it once and then we'll go ahead. So now let's go ahead. After we are done with what is actual cost and we have seen certain issues with respect to what certain ICDs. Now there are around 13 explanations. Pay attention please. Now this is very interesting and very important for us in exams. Below the definition of actual cost, this is the definition of actual cost, which is given under 43.1. There are around 13 explanations below it. Now, what are these explanations all about? These explanations talks about actual cost in certain special cases. So they define actual cost in certain special cases. By default, what is an actual cost? Actual cost means an actual cost. But in these 13 cases, actual cost is not actual, but it is something else. So in these 13 cases, actual cost does not remain actual. In fact, it is something else only. So we need to identify those 13 cases, and we need to also identify in those 13 cases individually what is the actual cost. Now, some of the cases we are not going to do it today because some of them are related to some other topics. Like many of them are related to the chapter of capital gains, and some of them are related to the PGBP subsequent provisions, which we are going to do in subsequent lectures. But don't worry, when the syllabus will be ended, you can make a note right now itself if you want. If you don't trust me, you can make a note right now that at the end of the syllabus, all 13 explanations will be done with you all. Okay, don't worry about it. So let us start with the first one. The first one is the explanation number 2, which we are starting. Okay, we are keeping this on hold. We are keeping this on hold. We'll be doing these things with capital gains because this is based on capital asset, capital gains. This is based on scientific research, which we'll be doing when we'll be doing scientific research section. Right now, I'm not interested. Right now, I am interested in only what? Those are purely PGBP provisions, which are based on depreciation. The first explanation which we are starting today is this. Asset acquired by way of gift. If somebody is giving you an asset by way of gift, or somebody is giving you an asset by way of inheritance, or you can write one more thing, somebody is giving you a gift by way of will. So if somebody is giving you an asset by way of gift, will, or inheritance, then what will be your actual cost? In that case, the actual cost will be the actual cost to the previous owner minus the depreciation which is allowed to that person. So suppose the previous owner has purchased the asset for 1 lakh rupees minus whatever is the depreciation allowed to that person till last year. Don't take the current year, till last year. Because in the year of transfer under income tax law, depreciation is not allowed. So if I am transferring, if somebody is transferring me the asset in 22-23, you have to reduce depreciation till 21-22 and see what is the WDV. That will become the actual cost in your hand. See here. So if the asset is received by way of gift or will or inheritance, your actual cost will be actual cost to the previous owner minus depreciation actually allowed to that person. So 1 lakh, for example, minus. Suppose if he has used the asset for 4 years, reduce the depreciation of 4 years, excluding the current year in which the asset is transferred. Okay. I hope it is clear. It's a very simple explanation. Coming to the explanation 3. Now, this is very important for us. This is also very important for us. These two explanations are extremely important for us in exams. So, be very careful about it. Okay. So, let me talk about these two explanations one by one. First, explanation 3. Explanation 3, I'll explain you with the help of an example. Suppose there are two persons. Pay attention, please. Why explanation 3 was introduced? That is what I'm trying to explain you. There is one person, Mr. A. There is another person, Mr. B. Both are friends. Mr. A is a seller. Mr. B is a buyer. Now, both are entering into an arrangement. Mr. A has an AC. The WDV of the AC is, say, for example, 20,000 rupees. Okay. Just 20,000 is the WDV of the AC. Now, Mr. A is selling that AC to Mr. B at a very high price. At a very high price, say of 5 lakh rupees. Therefore, this being a part of block of asset, Mr. A has to compute capital gain, selling price 5 lakhs minus WDV. In case of block of asset, capital gains is computed like this. You would have done in CA enter also. If you have not done, we will do in CA final. Don't worry. So you have to compare with what? WDV, not cost. In case of block of asset, you compare selling price with WDV, not cost. So this is 20k, and therefore there is a 4.8 lakhs. What? Short-term capital gains. Now, Mr. A is very smart. He is deliberately selling at a very high price because he has a short-term capital loss kept with him of 10 lakh rupees. And what he will do? He will set off this loss with this particular income and his capital gains will become zero and he will not be liable to pay any tax. So what is the advantage in this transaction? The advantage is in this transaction is to Mr. B. What advantage? Mr. B will get higher cost. Higher cost means higher depreciation he will get. That means lower profits. That means lower tax. Are you able to understand? For example, this jacket is an asset. And if I sell this jacket at a very high price and there is a capital gains. Okay. Or for example, forget about jacket. This phone is an asset. And if I sell this asset, sell this phone for a very high price. Okay. There will be a capital gains in the hands of the seller. No doubt. But I have lot of capital loss with me. So I will set off. So no tax implication in my hands. But my friend will get what? Higher cost. He will get higher cost. I will get higher depreciation, lower profit, lower tax. So the government said that if we find anyone buying asset at a higher cost, then the assessing officer will take an approval from joint commissioner and they will determine the cost of the asset. Check. Asset acquired at a higher price. Yes, Mr. V is acquiring asset at a very high price from any other person using the asset for his business or profession with a view to claim depreciation on enhanced cost and reduce tax liability. Yes, I am buying an asset at a very high cost with a view to claim more depreciation, enhanced depreciation with an intention of reducing tax liability. Yes, in that case, the actual cost will be determined by AO with the prior approval of joint commissioner. AO will determine the actual cost with the prior approval of what? Joint commissioner. Check. So the moment the AO comes to know that you are buying asset at a very high price, he will tell that I will compute the what? I will ask the joint commissioner about it. I'll take an approval from joint commissioner and accordingly I will determine your actual cost. Check. This is what this provision has to say. Beautiful provision. If you want to take a photograph of this, you can take this for your better understanding. Okay. Let's go ahead with the next explanation. Pay attention, please. What is the next explanation? Suppose this is financial year 15-16. Suppose, and there is Mr. A over here who has bought an asset for 1 lakh rupees. Now, after 2 years, in financial year 17-18, Mr. A has sold this asset to Mr. B. Then Mr. B has sold this asset to Mr. C. And then in 22-23, Mr. A is again buying that same asset from Mr. C. For how much? For 3 lakh rupees. So asset once belonged to Mr. A, then sold to Mr. B, then Mr. B sold to Mr. C. Then again the same asset is bought from Mr. C by Mr. A in 2020-23 for a very higher price. So in that case, the government says that we will not give you the actual cost as 3 lakh rupees. This 3 lakh rupees has to be compared with something else. With which amount it has to be compared? Let's see. Asset once belonged to the assessee, which was used by him for business. Yes. Once the asset was belonging to Mr. A, it was used by me. Then I transferred. Yes, then I transferred. And then I reacquired. Yes, then I reacquired that. Then the WDV at the time of original transfer. Original transfer means what? WDV at the time of original transfer means when Mr. A sold to Mr. B. At that time, what was the WDV? That is 1 lakh minus depreciation of 15-16 minus depreciation of 16-17. WDV at that time. You have to compare with that. What? The WDV at the time of original transfer. When the first transfer was made, at that time, what was the WDV? Or the price paid for reacquiring the asset. That is 3 lakh rupees. When you reacquire the asset, what was the price? Whichever is earlier, whichever is lesser, will be considered as your what? As your actual cost. So here you are doing what? You are making a loop by selling it to multiple person and then reacquiring that with an intention of increasing what? The cost. So you will not get the actual cost as actual cost. The actual cost will be reacquisition price or WDV at the time of original transfer, whichever is less. That will be allowed as actual cost. I hope it is clear to all of you. Yes, I hope it is. Let's move on to the next one. Explanation 4a. Now, what is this explanation all about? Let me give you an example of this one also. Pay attention, please. There is Mr. A over here. There is Mr. B over here. The Mr. B has purchased an asset of 1 lakh rupees. And he is claiming depreciation also. Say 30,000 he has claimed depreciation. 70,000 is the WDV. Okay. Mr. B has purchased an asset for 1 lakh. He has claimed depreciation of 30,000 for last few years. 70,000 is his WDV. Now what am I doing? I am acquiring the asset from him. After acquiring the asset, what I am doing? I am leasing back to him. Then in that case, suppose I acquired the asset for rupees 2 lakhs and then I leased back to Mr. B itself. Then in that case, what will be the actual cost in my hands? What will be the actual cost in my hands? What will be the actual cost? Technically speaking, it has to be 2 lakhs, but the government says no. In this case, the actual cost will not be 2 lakhs. Now you have to substitute the name over here with me. Asset acquired by an assessee, that is Mr. B. From another person, that is Mr. A. Sorry. Asset acquired by an assessee, that is Mr. A. From another person, that is Mr. B. We are acquiring from Mr. B, right? We are acquiring from Mr. B. Who had claimed depreciation? Yes, Mr. B had claimed depreciation on such asset. An asset is leased back to such other person. Yes, it is leased back to Mr. B. Then in that case, when you are acquiring the asset, what is the actual cost in your hands? The actual cost will be the WDV of the asset to the transferor. Who is the transferor? Mr. B is the transferor. So whatever is the WDV of the asset in the hands of the transferor, that will become the actual cost in your hands. So in that case, what is the WDV? 70,000 rupees is the WDV. So in this case, the actual cost will remain how much? Will remain 70,000. This is what explanation 4A to section 43.1 has to say. Just take a photograph of this. That asset once belonged to somebody else. That person is claiming depreciation. Then I am acquiring. Then I am leasing back the same asset to the same person. In that case, when I am acquiring the asset, the WDV of the asset in the hands of the transferor will become my actual cost. Check. So the 4 explanation which we have seen so far, I'll tell you. First, you are receiving some asset from someone in the form of gift or in the form of will or inheritance. Then what is your actual cost? Actual cost in the hands of the previous owner minus depreciation allowed to that person. In all the cases, you will take depreciation till last year. Don't take the depreciation of the current year because in the year of transfer in income tax, you do not get depreciation. I'll be speaking about that in some time again. Second, when somebody is selling asset at a very high price, then in that case, the actual cost in the hands of the recipient will be determined by AO with the approval of joint council. Then if I am selling asset to Mr. B is selling to Mr. C is selling to again me, then in my case, the actual cost will be when I was selling the asset for the first time, what was the WDV at that time compared with reacquisition price, whichever is less. And the fourth one is this one, which you can see on the board. Okay. Now, next one, pay attention please. Suppose if there is a personal, plant, machinery or furniture, personal. This phone is personal. Okay. Television is personal. Refrigerator is personal, for example, which I am using for my personal use, for example. Now, I am bringing this into business. Then what will be the actual cost? So, the government says that in that case, suppose I purchase this phone for 50,000 rupees. Mobile phone. Now, after some time, I am converting that into what? A business phone. Then what will be the actual cost? There is no explanation for such things. And if there is no explanation for such things, the actual cost will remain actual cost and it will be 50,000. Be very careful. Be very careful. If you take your furniture from your house to your office, the actual cost will remain actual cost. If you take your television from your house to your office, your actual cost will remain actual cost. If you take your TV from your house to your office, actual cost will remain actual cost. If you take your microwave from your house to your office, your actual cost will remain actual cost. Because there is no explanation for plant machinery furniture. Converting from personal use to business use, there is no explanation. Nothing like that is there. Okay. But what if I convert my personal building? Suppose I purchased a building in 2015-16 for personal use, and 2020 to 23 I'm converting that into a business use. Then what will happen? Then what will happen? Then also actual cost will remain actual cost. No, no, no. Now there is a specific explanation given by government for building. For building, the government has given a specific explanation. For plant, machinery and furniture, actual cost will remain actual cost. Be very careful. So for building, there is a different treatment. For rest of the asset, there is a different treatment. Sir, what is the treatment for building? Let's read together. Building used for private purpose. Okay. And subsequently brought into business use. What will be the actual cost? The cost of purchase or construction of the building as reduced by notional depreciation calculated at the rate of depreciation applicable to the year of conversion in the business use. So what are you supposed to do in this case? Nothing. Nothing great as such. Just see at what price you have purchased the building in 2015-16. Suppose I purchased the building for 1 crore rupees. Then you have to reduce the depreciation. For 15, 16, 16, 17, 17, 18, 18, 19, 19, 20, 20, 21 till 2021. Don't reduce for 22, 23 because that is the year in which you are converting. So reduce the notional depreciation for this year. Notional depreciation, because depreciation is notional because you are using it for personal purpose. It cannot be called as actual. Reduce notional depreciation. Then whatever amount will left, that WDV will become actual cost in 2022-23. So what will be the rate of depreciation? The rate of depreciation for all these years will be of 2022-23 only. So for all the years, you are supposed to take the current rate. Whatever is the current rate running right now in the financial year 22-23, you are supposed to consider that rate over here. Check over here, please. The cost of purchase or construction of the building as reduced by the notional depreciation calculated at the depreciation rate applicable to the year of conversion. So year of conversion is 22-23. Whatever is the rate applicable in the current year, you are supposed to take that rate. Okay. I hope it is clear to all of you. Right? So this is what this explanation is all about. For building, there is an explanation. For plant, machinery and furniture, there is no explanation, unfortunately. Or fortunately, whichever way you take. And for plant, machinery and furniture, actual cost will remain actual cost. Always. Okay. Let's go ahead. There are some explanations which are missing in between. We'll be doing that. Don't worry. Explanation 6, 7, etc. Coming to explanation 8, which I have already told you. How? I'll again tell you if you want. Once the asset is put to use, okay, you have taken a loan for buying an asset. So till the time the asset is not put to use, what do you do with the interest cost? Till the time the asset is not put to use, you capitalize the interest cost to the cost of asset. But once the asset is put to use, what will you do with that interest cost? That interest cost will go to P&L account, right? That will not form part of actual cost of the asset. Because once the asset is put to use, the interest will now go to what? P&L account. This is what this explanation wants to tell you. Asset acquired out of borrowed funds. Okay, you are borrowing funds and then you are acquiring an asset. Interest on loan borrowed relating to period after the asset is first put to use shall never form part of actual cost. Once the asset is put to use, after that, whatever is the interest cost, that shall never form part of what? Actual cost. It will never be part of what? Actual cost. Is it clear? It will be going directly to the P&L account. And you can claim that as what? As an expense. Okay. Now, next, explanation 9 is a very simple one. Nothing great as such. Let me explain you with the help of example. Explanation 9. Pay attention on the board, please, all of you. What is explanation 9? Pay attention. Suppose I purchased a machinery of 10 lakh rupees. Now, obviously on this 10 lakh rupees machinery, in most of the cases, I would have paid some GST, say 12%, 18%, 5%, whatever it is. So say I have paid 12% GST on it. So this machinery is now worth rupees 11 lakh 20,000 rupees to me. Okay. What the government says that if you have claimed a credit of GST on this, if you have claimed GST credit on this amount, which you are eligible to, then you cannot claim depreciation on this amount. You have to claim depreciation on this amount. You cannot take both the benefits. So if you are purchasing something and you are claiming GST credit on that, input tax credit on that, as per the GST laws, then in that case, you cannot claim depreciation on that much portion. On that much portion, depreciation is not allowed. So in this case, this is what this explanation has to say. So assessee has two options. Which two options? Option 1, claim GST on how much? 1.2 lakhs. Then no depreciation. On what? On 1.2 lakhs. You can claim depreciation on 10 lakhs. No issue. Option 2, no GST. Then claim depreciation on entire what? 11.2 lakhs. Both the options are there. Whatever you want to take, you can take. Okay. So there is nothing great in this explanation as such. Not important for exam very much. Asset acquired subject to the levy of GST in respect of which input credit is availed. So much of the GST or duty in respect of which a claim of credit has been made and allowed shall not form part of what? Actual cost. It shall not form part of actual cost. Government will not allow you that as a part of what? Actual cost. Okay. Okay, fine. So if you are claiming a GST credit on a particular item, then that such amount will not be eligible for what? As a deduction for depreciation. Is it clear? I hope it is clear to all of you. Okay. So there has been a power cut at my place. So suddenly the lecture got stopped in between. So I thought of going and getting the makeover done. So finally I got some time to do the makeover. My family was also shouting at me since last so many days that go and cut your hair, go and trim your beard. So I said now I will go today because the electricity is not there. Anyways, let's go ahead with the discussion. This is what we have been doing. Explanation 9, which we have done earlier before the makeover. Now after makeover, let's go ahead with something big, something important. Explanation 10, extremely important, and it's a long discussion now, which will go on for around half an hour at least. So pay absolute attention now on explanation 10. Explanation 10, what does it say? It says that if you are buying an asset, suppose if you are buying an asset, the cost of the asset is say 100 rupees. And if somebody is giving some subsidy, grant or reimbursement for the same, it means in some or the other way somebody is helping you. Suppose if somebody is helping you to the extent of 20 crore rupees, then that much has to be reduced from the actual cost. Because that much amount you have not paid from your pocket and therefore your actual cost will be how much? 80 crore rupees. Okay. So if somebody is helping you to buy an asset in the form of a subsidy, grant or reimbursement, that much amount should be reduced from the actual cost. It is as simple as this. Now, let me give you one more example. Suppose there is government over here. Okay. And there is assessee over here. And the assessee is starting with a new project of say 120 crore rupees. In this project, there will be some plant and machinery. There will be some furniture. There will be some building. It's a project which has many assets. So the plant and machinery is say 50 crores. Furniture is say 20 crores. And building is also say 50 crores. Okay. Now, the government is not financing an asset, but they are financing you lot of assets. This is singular. This is plural. The government is now financing lot of assets and the government is saying that we will finance you 20% of the project. So 20% of the project will come to 120 crore, 20%, 24 crore. The government is saying that we will finance you how much? 20%. That is 24 crore we will finance. Out of 120 crore, 20 crore we will finance. Now what assessee is doing? Assessee is trying to play very smart and he is trying to reduce this from year and year. And he is not reducing this from year. Why? What can be the possible logic? The logic is very simple. That reducing this 24 crore from year and year will be beneficial for the assessee because furniture is depreciated at 10%, building is depreciated at 10%, but plant and machinery is depreciated at 15%. So the assessee is thinking why to unnecessarily reduce that asset who is depreciated at higher percentage. Plant and machinery is depreciated at 15%. So we will not touch that now. We will touch what? Furniture. We'll reduce furniture. The loss will be lesser. We'll reduce what? We'll reduce building. The loss will be lesser. And therefore, the assessee is doing what? The assessee is reducing this 24 crore from year and year. So the government said no. It is not allowed to be reduced like this. You have to reduce proportionately from all three of them. Proportionately means from this you have to reduce 20%. That is 10 crore. You have to reduce from this. From this you have to reduce 20%. That is 4 crore. You will reduce from this. And then 10 crore you will reduce from this. And this is how you will reduce your 24 crore rupees. Okay. So if the finance is, if the subsidy, grant and reimbursement is for a single asset, then reduce from that asset. But if it is for all the assets, it is for plural, lot of assets, then you have to reduce proportionately from all the assets. You can take a photograph of this if you want. Okay. Now I will read the provision for you all. A portion of the cost of asset acquired is made directly or indirectly by government or any authority or any person in the form of subsidy, grant or reimbursement. Underline the words subsidy, grant and reimbursement. These are the three important words which we have to underline and keep it in our mind. Now, the first part is this, the second part is this. So much of the cost of asset as is relatable to such subsidy, grant or reimbursement shall not form part of actual cost. So, you should reduce that much from actual cost. If the subsidy is not directly relatable to an asset, but it is subsidies with reference to assets, assets means plural. It is in relation to lot of assets, then reduce proportionately. Proportionately reduce from the actual cost of the assets with reference to the subsidy which has been granted. Okay. So, you have to reduce proportionately. Now, after this explanation came, there was some doubt in the minds of assessee. Now, let me tell you what was the doubt. Pay attention, please, all of you. Then you also try to answer that particular thing to me. Okay. Pay attention on the board. Pay attention. Suppose there is an assessee over here. And there is a government over here. Now, this assessee has taken a loan for fixed assets from government, and this is the balance sheet of the assessee. Loan 5,000 crore, and they have purchased fixed asset out of this loan of 8,000 crore. 3,000 crore they have put from their pocket. Now, after some time, there was huge loss to the assessee in the business of the assessee. So, assessee went to the government, and the government assessee went to the government for waiver of loan, and the government fortunately waived it. They waived this 5,000 crore. Okay. Now, because the government has waived this loan, listen carefully now. Please, all of you. You have to think and answer now. And the government has waived this loan. They have waived it. They have said that we will not take this money from you. This money is given to you forever. Now, is this a benefit or not? Yes, it is a benefit. Now, will this 5,000 crore be reduced from this as per explanation 10? You have to answer this first of all. Will this 5,000 crore be reduced from this 8,000 crore as per explanation 10? And the answer is no. This waiver cannot be reduced from what? This waiver cannot be reduced from what? It cannot be reduced from your actual cost. Why? Because this waiver is neither subsidy nor grant nor reimbursement. If you get subsidy or grant or reimbursement in respect of a fixed asset, then that has to be reduced from the block of asset and not waiver. So what will happen with this? Nothing. So the government saw that nothing is getting happened with this. How can we leave something like this? So in Finance Act 2015, what they did? They amended the definition of income. This is where the income is defined under income tax law in section 2 clause 24. They inserted this new clause in the definition of income and widened the scope of taxability. How? Let's see. Just have patience. It has lot of things. I have to say lot of things in this, please. Pay attention, please. Definition of income includes assistance in the form of what? Subsidy is income. Income. If it is income, means you have to add to income and pay tax. Okay, subsidy is income. Grant is income. Cash incentive is income. Duty drawback is income. Waiver is income. Concession is income. See, waiver is income now. Income now. Concession is income. Reimbursement is income by whatever name called. All these things are what? Income. After Finance Act 2015, they have amended this provision in Finance Act 2015. Now, all of them are income. When they are income? If it is given by central government. If these things are given by central government, then it is income. If these things are given by state government, then it is income. If these things are given by any authority like local authority, municipality, gram panchayat, these are authorities, then it is income. If these things are given by statutory bodies like RBI, etc., then it is income. If these things are given by any statutory agencies, then it is income. So if you have a close eye on these people, these are all governmental people. So these are income. Listen carefully. It's not that simple. Please pay attention. These are income, provided it is given by these people. And if these people are giving you these things, then it is income. If it is income, add to income statement. So now people started having one doubt. What doubt? If I get a subsidy, listen carefully. If I get a subsidy, see what I am highlighting, from central government for buying a fixed asset, then what shall I do? Shall I treat that as income or shall I do the treatment as per explanation 10? What shall I do then? Because as per explanation 10, that much subsidy has to be reduced from the cost of asset. But as per this definition, you have to treat that as income. What shall I do then? There is a clash of interest between two provisions. Explanation 10 says what? If you get any subsidy with respect to an asset, you have to reduce from cost, and here it is written, if a subsidy is received from central government, then you have to do what? Treat it as income. Then what shall I do? You follow this. Don't follow this. Why? Because this particular thing is excluded from the definition of income. Check. It means for asset, whatever you used to do earlier, you have to do the same thing now also. Because that is excluded from the definition of income. Check please. Check please. Because it is written other than subsidy or grant or reimbursement referred to in explanation 10. And in explanation 10, which subsidy, grant and reimbursement is referred? Which is in reference to what? Fixed asset. It means if the subsidy or grant or reimbursement is with respect to fixed asset, then you will do what? You will reduce it from the cost of asset. Don't treat it as income. But if the subsidy, grant and reimbursement is not with respect to fixed asset, the subsidy is some other subsidy, like say government is giving you subsidy for electricity bill, then it is income because that is not for fixed asset. Suppose if the government is giving you subsidy for say buying raw material, then it is income because that is not for fixed asset. I hope it is clear to all of you. Therefore, if the subsidy, grant or reimbursement is for fixed asset, go to explanation 10, reduce from the block of asset. But if the subsidy, grant and reimbursement is for what? Not fixed asset. Is for expenses, then income. What about waiver? Waiver will always come over here. Because waiver cannot go over there because in explanation 10, waiver is not written. Yes or no? Waiver will always come under income only. So in this example which I have written on the board, this 5,000 crore rupees which is waived by government, this will be income. Because that cannot be covered in explanation 10. In explanation 10, only subsidy, grant and reimbursement is covered. I hope it is clear to all of you. Okay. So from the definition of income, they have excluded what? They have excluded explanation 10 fixed asset, subsidy, grant, reimbursement. The second thing which they have excluded from the definition, which they do not intend to take tax on, that is if the central government is giving some subsidy or grant to the central government trust or state government trust. So if the giver is central government and the receiver is central government trust or state government trust, so the giver is who? Central government, and the receiver is central government or state government trust, then no income tax. So I am central government, I am giving some subsidy to my state government, to my central government trust, or I am giving some subsidy to my state government trust, then it is not taxable. Sir, what if a central government gives some subsidy to local authority? Then it is taxable, because the giver is central government and the receiver has to be central government or state government trust, not local authority. Not local authority. Then it is taxable. Okay. So this is also excluded from the definition of income. The first thing which is excluded, why? Because it is already covered in explanation 10. The second thing is excluded, why? Because it is given by government to government only. Doesn't make sense to take tax on that. The third thing, LPG subsidy. Do you know once upon a time the government used to give LPG subsidy on cylinders. Now they don't give that. So will that be taxable, sir? That will also be taxed. No. Government has clarified that LPG subsidy and other subsidies which are for the benefits of the individuals are not taxable. Like, for example, if the government is giving some subsidy to some children for education. Government is giving some subsidy to some students for further education. All of them are not taxable. Don't worry about it. Check. Check. Okay. Now you have to be very careful with one thing now. Wait. The things are not yet done. There are a lot of small things that I have to speak here. Pay attention, please. Shall I say? Yes. So if there is a subsidy, grant or reimbursement with reference to fixed asset, then where you will go? You will go to explanation tab. If there is a waiver, then you will come to income. Income definition. If there is a duty drawback, come here. Concession, come here. Reimbursement, then you go over there. Because it is specifically covered with reference to fixed assets. Other things, other than fixed assets, it will come here. Now, I would like to ask you one very simple question. You have to think and answer. Look at the book and answer. Huh? Suppose I have taken a loan for what? Fixed asset. From ICICI Bank. Okay, of 1000 crore. Now that loan is waived by ICICI Bank. Waived. ICICI waived that loan. First question. Will it come here? Loan taken from ICICI Bank, waived by ICICI Bank. Will it come here? The answer is no. Because waiver is not covered here. Second thing. Will it come here? Can it be called as income? Because waiver is covered here. The answer is no. Why no? Don't just see whether waiver is covered or not. Also see who is waiving. It has to be waived by central government, state government, body, agency, authority. Not ICICI Bank. So if an ICICI Bank waives your fixed asset loan, it can neither be covered in explanation 10 nor covered here. It has no treatment, no tax, nothing will be taxed. Be very careful. So this is the ultimate conclusion of this entire discussion which we have done. Point number 1. If the subsidy is for acquiring fixed asset, if it is for what? Acquiring fixed asset, then without any second thought, reduce from what actual cost as per explanation 10. Any other subsidy, etc. will become taxable under PGBP or of IFRS if it is received from central government, state government, authority, body, agency. So if it is received from these people, then it will be income. If it is received from any other person, then it is not income. Therefore, if a waiver is done by a company, then it shall not be taxable and it is a capital receipt. It will not be taxable in that case. It will become a capital receipt in your hand. Be very careful about it. Okay. Now, there is one ICDS based on government grant over here. Let's understand that ICDS now. So there are two parts in this ICDS. The first part of this ICDS is the timing. Timing means when to recognize the government grant. And the second part is how. How means treatment. And in fact, the third part is if we have to give refund. In case of refund, what has to be the treatment? So we have to learn all these three things over here one by one. Okay. So this is ICDS 7 based on government grant. Let us try to understand this ICDS now one by one. First of all, we'll try to understand the timing of recognition of government grant. When should I recognize government grant? Government grant are available to any person subject to lot of conditions. No government is going to give you grant without condition. They will attach lot of conditions to it. So you have to fulfill the conditions. Then only grant is eligible to you. So if the government is giving you some grant which are subject to conditions, which is definitely subject to condition in most of the cases. So the government says that you should not recognize the grant until there is a reasonable assurance, until you are 100% sure that you will comply with the conditions attached. So if you are 100% sure that you will comply with the conditions attached, then you can what? Recognize the government grant. But if you are not sure, then you cannot recognize. So for that, suppose the government has given you 10 conditions, subject to which you will be getting the grant, and the government has given you 100 crore. Now you know that yes, you will easily fulfill all the conditions, then recognize. But if you feel that no, the conditions are very dangerous, it may or may not be fulfilled, then you may not recognize. Secondly, unless and until you are sure that, second condition, that the grant shall be received. So you should be confident about the government with whom you are going to get the grant. You should be very sure that the government who is going to give you grant will give you the grant definitely. In case they don't give you, then the government does not have a good record. The past record is very bad of the government who is going to give you the grant. In that case, what will happen? In that case, the government says that the government grant should not be recognized. So there are two conditions which you have to fulfill. These conditions you have to fulfill. This is something which is your obligation. And this is something which is government's obligation. So if you are sure that you will fulfill the condition, secondly, if you are sure that the government will give you the grant, then you recognize. Or else don't recognize. If you are sure that you are not going to fulfill the condition, then don't recognize. If you are sure that government is not going to give you the grant, the government has the past record of not giving the grant on time, then don't recognize. Secondly, once you have received the grant, then there is no question of postponing. Once you have received it, then you have to recognize the grant and you have to pay tax on that. So the timing is very important when to recognize. You should not recognize unless and until there is a reasonable assurance that you will fulfill the conditions and there is a reasonable assurance that you will receive the grant. Once you receive it, then you have to recognize. Now coming to the treatment. What is the treatment? The treatment differs depending upon the nature of grant. Suppose if the grant is for depreciable asset. So this first one and the third one is for depreciable asset. So what we do for depreciable asset? The same way we are supposed to do over here. The ICDS cannot tell you a different treatment as compared to what the income tax law says. The ICDS has to give you the same treatment, the way it is given under the income tax law. So what you do for depreciable asset, where the government grant relates to depreciable asset, then deduct from actual cost. Deduct from what? Actual cost. Where government grant cannot be directly attributed to their asset. If a grant is not for asset, but it is for group of assets, plural, then deduct proportionately from actual cost. You have to deduct from all the assets proportionately. So if the government grant relates to a depreciable asset, if it relates to what? A depreciable asset, single asset, then reduce from the asset. If it is for lot of assets, as we have seen here, we have noted down the example also, then you have to reduce proportionately from all the assets. Okay. Third, if the government grant is a compensation, there is some loss which has occurred to the assessee because of the government. There was riots in the state, and because of that, there is a loss to my factory. There was flood in the state. There was earthquake in the state. So government is giving me compensation. So when is that compensation taxable? When it is receivable. Whenever it is receivable, when the government gives you a confirmation that we are going to give you this much amount, at that time you are supposed to recognize that and pay tax. What about other than these cases? Second one I'll speak about in a while. What about other than these cases? Other than these cases, you have to follow the matching concept which you follow in accounts. You have to follow accounting treatments. Whatever you follow in accounts, you have to follow that. Now, let me speak about the first and the third one once again. Suppose the cost of the asset is 100 rupees. and the government is giving me grant of how much? 20 rupees. Then I have to reduce that, and that will become 80 crore will be my actual cost. Now, this 20 crore is subject to what? Is subject to conditions. This 20 crore is subject to conditions. In case I do not fulfill that condition, in case I do not fulfill that condition, then I have to give this 20 crore refund back to the government. Yes, you are supposed to give this 20 crore back to the government as refund. Then in that case, what will be the treatment? The treatment will be reversed. What will you do? Just check here. Refund in case of depreciable asset. You should increase the actual cost or WDV of the block. So, when you receive the grant, you have reduced from the actual cost. So, when you refund the grant, you have to add it back to the block of asset. It is as simple as that. The treatment is exactly opposite. Okay? It is exactly opposite as compared to what it is. Is it clear? I hope it is clear to all of you. Now, the second one requires some example where the government grants relates to non-depreciable asset. Now, let me explain you this. Wait. Now, let me give you an example. The second one. Suppose the government is giving you a grant of 100 crore for buying some raw materials. So, you will pass a journal entry. Bank account debit 100 crore to government grant. 100 crore. And this is your balance sheet. And in the balance sheet, you will show government grant as what? 100 crore. And bank account as what? 100 crore. Okay. This is the first treatment. Now, how to recognize this grant? So, now this grant is given by the government to you for what purpose? For raw material. For buying some raw materials. So, as and when you will meet the obligation, as and when you will buy the raw material, you have to recognize this grant. Suppose you have bought a raw material of 30 crores. So, now this is your P&L account, and now you will recognize government grant as 30 crores. Okay, this is what the provision has to say. The government grant shall be recognized as income over the same period during which the cost of obligation is charged to the income. So, as and when you will fulfill your obligation, you will do what? You will recognize that as income. Now, therefore, now the moment you will recognize this as income, this will become how much? Pay attention, please. This will become how much? This will become 70 crore now. Okay. So, this will become 70 crore. This will become 70 crore. Now, after this has become 70 crore, okay. Now, suppose if I do not fulfill the conditions in future, and now the government says that you have to refund 100 crore because you are violating some conditions, then what to do? Then what to do? Then you will be having 70 crore in your bank account, you will give that amount and you will knock off this 70 crore, you will pass an entry. Government grant account debit 70 crore to bank account. How much? 100 crore. And the differential amount of 30 crore you have to bear back because that will be your expense now. You have to bear that as an expense and that will go out of your pocket. And that is what the treatment is all about. The refundable amount, that is 100 crore, should be first applied against unamortized deferred credit. How much is unamortized deferred credit? 70 crore. And the excess can be charged to P&L. How much is the excess? The excess is 30 crore. The 30 crore will be charged to what? Will be charged to P&L account. So, this 100 crore has to be first adjusted against the unamortized credit and the 30 crore will be adjusted towards because that is your loss now because that has to be going from your pocket. So, you have to pay that from your pocket and you have to adjust that. You can just take a photograph of this if you want. Okay, not very important for exam, let me tell you very clearly, but still it is there in your syllabus, so we are doing it, not very important. Okay, don't worry much. Okay. Now, so this is what the discussion of subsidy, grant, reimbursement is all about. Let's move on to the next part. The next part is what? The unabsorbed depreciation. What is the treatment of unabsorbed depreciation under the income tax law? Section 32 subsection 2 talks about the treatment of unabsorbed depreciation. Pay attention, please. It's very unique as compared to the other losses. Generally, what happens when you carry forward any loss, you carry forward that loss for a particular period, for 4 years, for 8 years, right? Here, the first advantage, you can carry forward that for infinite number of years, no limit. Time limit is not there. This is the first advantage. Second advantage, unabsorbed depreciation can be set off and carry forward and set off against any income except salary income. So if you have an unabsorbed depreciation, you have to first set off against PGBP because it is related to business. And after that, if amount is left, you can set off against HP, you can set off against capital gains, you can set off against IFRS also, but not against salary. So this is the two biggest advantage of unabsorbed depreciation. First, no time limit. You can carry forward and set off for infinite number of years. Second, you can set off against any income except what? Salary income. Now, there is one very important thing which we have to keep it in our mind. Pay attention, please, all of you. Pay attention. Suppose my PGBP is 10 crore and I have three things. I have business loss, I have UAD, I have current year depreciation. And my business loss is what? Business income is how much? 10 crore. Suppose my business loss is 5 crore and this is 6 crore and this is 7 crore. Then what will be my priority of set off? What will I set off first against this? Then what? Then what? Always remember, the first priority will be to current year depreciation. Why? Because it is mandatory to claim depreciation. Mandatory to claim depreciation. Always first this. Always remember the second priority should be this. Why? Because this will get lapsed after some year. It will get lapsed after some year if you do not set off this. Because it is coming with a time limit. It is coming with an expiry. So it will lapse after 8 years. The third priority will be this. What is this? What is UAD? That is UAD. You will take UAD at the end, please. Do not consider UAD at the beginning. This has to be your priority. Number one, this. Number two, this. Number three, this. I have told you with logic. Why number one, why number two, why number three. Okay. Now pay attention over here. Number one, current year depreciation. Number two, brought forward loss. Number three, unabsorbed depreciation. There is something written in the bracket. We'll be talking about that after some time. Don't worry about it. Okay. So we will stop the discussion of depreciation here. Otherwise, it will be too much of depreciation for us in a day. And we'll continue the discussion of depreciation in subsequent lectures. And don't worry, we'll be doing a lot of questions also. Don't worry about it. Okay. There will be sufficient questions we'll be doing in the class itself. Okay. So take care, all of you. I hope you all are enjoying the CA final direct tax fast well batch. Take care.